Hello and welcome to Livewire Markets. My name is Anna Dadich and today I am joined by Jacob Mitchell, Chief Investment Officer at Antipities Partners. He will be sharing his insights on the market cycle and on staying resilient during times of uncertainty. Hi Jacob, thanks for joining us.
Thanks Anna. Thanks. It's great to be here.
Jacob, you've been in markets for a long time. I'd love to start by just getting your perspective on things. When you look at where we are at today, how does it compare to what you've seen through previous cycles?
Yeah, look, obviously there's echoes, if you like, of the 2000 tech bubble, but there's similarities, but there's also some key differences. Financial markets have evolved. Back then it was more about a bubble in a narrow part of the market. Today we think it's a sort of slightly different. Overvaluation tends to be concentrated in sort of quality stocks, especially US. We've had US exceptionalism, and some of that is being earned by higher productivity, but some of it's also been cyclical, just looser fiscal policy in the US. So at the end of any long cycle, you do get a build-up of risks, and I think we're seeing that, and we're sort of investing with a view that you need to really adopt a capital preservation mindset.
With so much to unpack in markets right now, what are you and the team focusing on most closely? If you could give us a look inside the discussions happening at the Antipities War Room.
Yeah, look, it's trying to just stay balanced. It's easy to get caught up in the tariff noise. It's sort of monitoring the signs of any weakness in the hard data. Secondly, it's also focusing on areas where you may get positive surprises. Look, Europe has articulated finally, Germany is on board with the idea of loosening fiscal policy in Europe. So Europe can at least, I think, respond to any tariff headwinds with domestic stimulus. China has options there as well. I mean, the property market has been a big drag on Chinese growth, and they're now moving past that peak of they're actually sort of trying to stimulate domestic consumption to offset tariffs. So there are positives. I mean, the unintended consequence of Make America Great Again could be it ultimately makes the rest of the world great and more investable than it has been. You've got to be very mindful of how risks are priced, and if we think there's exposures in the portfolio that are pretty fully valued and they do have tariff, sort of a fat tail risk exposure to tariff, we don't need to be there. There's lots of other opportunities, and so it's trying to eliminate the negative tails in the portfolio.
Okay. So one of the hallmarks of Antipodes is a focus on capital preservation and optionality. How are you positioning portfolios to weather the ongoing uncertainty while staying opportunistic?
Yeah, sure. Look, capital preservation starts with, paying the right multiple relative to, the company's growth rate and its underlying business resilience. Step one. That's what the focus of all of our research efforts are. We really start at the industry layer, then we iterate to the real winners and the losers and how they're priced. So that permeates everything we do. Look, we do think it also matters to have a view on the macro, because it can't ever overpower your bottom-up view, but it will keep you out of parts of the market. When it's late cycle, I think it is important to monitor that. I mean, I certainly have seen that through different cycles, and it's something I've learnt the hard way. Every 7 years or so, the macro does matter, and you can't just wake up one day and sort of switch on and say, okay, what do I need to worry about? You need to have a process that identifies that as you're on the journey. Probably the biggest observation for us is that if you do a quick survey of valuations, it still looks like the US is somewhat exceptional on the high side. We don't think you haven't had earnings downgrades. I think inevitably you will start to get. It was notable to us that coming out of the last reporting season, you didn't see upgrades. And we think earnings growth is probably too high relative to policy uncertainty. So, and the starting multiple at roughly over 20 times is quite high relative to the emerging markets or to Europe. And so we still have in our portfolio, we're tilted into cheaper multinationals in Europe. We're tilted into domestically exposed emerging market companies, and we think those tilts will continue to work. Mid caps are very cheap. If you're taking on cyclicality, though, I think you've got to be very comfortable with the idea that there's a recession priced in. We're cautious around just broadly taking on cyclical risk, given we think there's still a rising risk of recession.
So you've spoken before about being selectively contrarian or maintaining an independent mindset. Where do you see the most compelling opportunities that consensus might be missing? If you could, list a couple of examples to crystallise that thinking.
Yeah, look, there's probably we'll talk about a couple of stocks. I mean, in the mega caps, we think probably Alphabet is the most contrarian idea, and for just the observation, it's on 18 times, so it's a quite an attractive multiple for that company in both an absolute and relative sense. And it's derated because of concerns around a widening range of outcomes with competition from ChatGPT, OpenAI, in really a lot of queries essentially shifting away from the search engine to a chatbot. And that's happening. That is happening. Probably the good news there is that there's only really two players in the market in that sense. It is Alphabet and OpenAI. Most of the queries that have shifted wouldn't have been commercial queries or queries that Alphabet would have monetized anyway. And we think they're fighting back in terms of, just incorporating a lot more AI into their own. You would have seen in your own Google search just a lot more answers from AI. Yeah. So keeping the eyeballs where they should be, and you can see it in the last quarter. I mean, the search business still grew, 8%. Now, it will have sensitivity to a weaker economic environment, but you're getting that in a very high quality company. And in an environment where quality stocks are very expensive. Walmart trades on over 30 times, and we're getting this business, which is a high growth business, and it's got two other amazing assets. It's got YouTube, it has the cloud business. The cloud business is growing very nicely. So look, we think there's a lot, and then you've got a lot of optionality. You mentioned, yes, we do like to build in optionality. You can think about what most of Tesla's market cap is, the autonomous driving opportunity that investors, robo-taxis, et cetera. You've got to think that Alphabet's Waymo business has just as good an opportunity to monetize that. And we would argue you're paying nothing for it in Alphabet's valuation. So I think that is a contrarian, independent idea. We understand why it's derated, but we think that is that's overdone relative to the underlying growth rate and business resilience. So it epitomizes pragmatic value. Look, other areas I think would be more, let's call it defensive exposures, which are considered boring by the market, like utilities in Europe, in the US, especially ones that have exposure to transmission assets, where we're just seeing a lot of demand as we open up. Combination of energy transition, data center. You can just buy nicely positioned utilities whose very much protected by regulation, but whose growth rates are going to shift from being sort of 5% per annum to sort of 7 and 8% per annum. And that doesn't sound like a lot, but in utility land, that is a lot. And it's not, and those companies haven't re-rated to reflect that higher growth. And you get an optionality on lower rates, lower discount rates if we do have a recession.
Has the definition of quality changed?
Yeah, look, I think it's always changing, in different ways. From this how investors think about it from a business model perspective, how they think about it from a sector expression. Once upon a time, for instance, large cap pharma stocks were seen as high quality. Once upon a time, consumer staples were, and still, both of those groups are still expressions of quality, but they're not behaving like the factor is today, right? They're actually getting, they're derating, and that's probably because, like anything in the market, there's got to be some underlying structural reason for a company to re-rate, to trade on a higher multiple. And it's usually, just demand, there's structural demand drivers. And in consumer staples, a lot of the markets are mature. Those companies are struggling to get pricing power against the domination of Walmart and Amazon. There's lots of different, shifts in consumption patterns, or towards healthier foods. Lots of multiple sort of headwinds, if you like. And then in the case of pharma stocks, investors started to work out a lot of the innovation was starting to become fairly incremental. Fewer blockbuster breakthrough. And now we actually think in case of pharma, there's selective opportunities. We own Merck, we own Sanofi. We do think they're cheap relative to their pipeline. We still think there's returns on innovation that they can generate internally, and that's not reflected in the multiple. So today, there seems to be a concentration in mega cap. So there's still those consumer names that are growing a little bit faster than their peer group, and they're trading on really high multiples. And then we have the cloud and the mega cap cloud companies and advertising companies. They seem to us to be the quality of expressions of quality, certainly in the cloud computing space, that seem most underwritten by the longevity of the structural trend. We don't think it's a crazy multiple to pay buying Microsoft on, a 27 times forward multiple. It's crazy for a company that is growing sustainably 12, 13% per annum. Walmart is on a higher multiple and it's growing a lot more slowly. So it's finding either, I think, quality that's underwritten by structural growth and the sustainability, and testing the sustainability of that, or areas where the market's become just like pharma, we think, just getting way too negative around the businesses, getting these businesses on 10 times just seems very cheap for us, given they're growing sort of like a Procter & Gamble, which is on 25 times. So there are looking for it in less obvious places, and always testing that if you're paying a higher multiple, just make sure that the longevity of that structural trend is intact.
On the other side of that, where do you see the biggest risk, and what are you doing to, mitigate or avoid that risk?
Yeah, every cycle, as I said at the outset, is different. And as you get to late cycle, where have you had overinvestment? Where have over extrapolation? When I was at Platinum Asset Management in 2007, working on, in the North American, managing money and managing risk, and really focused a lot on North America. We could see just this build up of, what was happening in the mortgage market was unsustainable, and it was very much wired into the whole financial system, and it could be quite destabilizing. And so we really did, seek to immunize the portfolios from exposure. And if we come forward to Antipities, the Antipities Global Fund, which is our variable beta long short fund, not only can we immunize by not having exposure to obvious tail risk in the long book, but we can also short. Now, and we can do tail risk hedging, and that's a core part of our process. So where we see the risk today is actually just the high growth in private credit and the relationship between private credit and private equity. Private credit in the US as a pool of lending has grown at about 20% per annum for 5 years. So very, way above economic growth. So you have to think that there's maybe been some lending done that is relatively aggressive, and it's very different. Private credit leverage in the US versus, say, what we have here in Australia. I'd like to make that really clear. It's much higher risk, and that's where we think the biggest tail risk is. And in our, in our long-short fund, in the recent volatility, we've been, paid on specific stock-specific shorts in that area, as well as just having, a preference for high-quality balance sheets. Yeah.
Moving back onto AI and that topic, you've spoken a lot about it in the past and not getting caught up in the hype. You say that instead you should be focusing on identifying businesses that can use AI to create sustainable advantages. So if you can walk us through that process and what the characteristics are of that.
Yeah, look, as any technology matures, it will be, and as the cost of the technology falls, you obviously just get broader adoption, and where, it's happening, very quickly in the case of AI. So the cost of inference keeps falling. You could see the, the DeepSeek moment, and the observation now that Huawei is training, Huawei's chips are performing relatively well versus NVIDIA chips. And so we think the focus is now shifting beyond the need to build data centers, and clearly we still are going to train foundational models, and that will require leading chips. But we have many, when it comes to inference, we think it will happen across a broad range of different chips. And and obviously Alphabet's a great case in point that they're basically running their models, not only running them but training them on their own chips, on their TPUs. So that's why we've been wary about NVIDIA. We just think whilst it's derating for a reason, because the market it isn't the monopoly that many investors think it is. So as cost of inference falls, it's really going to lead to some very unfair outcomes. Capitalism is never that fair.
Not kind.
Not kind, and there will be some big winners and lots of losers. I think it's a little bit more democratic this cycle. You can have just bread and butter businesses like one that we've spoken a lot about, Capital One Financial, that just has, is a leading dominant credit card provider in the US, that has built its banking stack natively in the cloud. So it's just very well positioned against its competitors to adopt a lot of the AI tools in its business. So having your data organized is a really, a key competitive advantage. And every one of our analysts in our sector teams, when they're looking at their specific industry, is identifying who that company is. To the extent it's a consumer-facing company, a company where data is can be your competitive advantage. And credit cards are great, because your two biggest costs are, controlling your credit cost, making, well-priced loans to your consumers. Secondly, finding those customers, so marketing. And both of those activities are perfect for AI optimization. So not an expensive stock, forward multiples 6-7 times, just pulled off the merger with Discover. So now unassailably the dominant credit card company in the US, where it's actually hard to find dominant, outside of JP Morgan, very few dominant financial franchises. Regional banks are very competitive, very commodity lending. We're pretty excited by AI adoption, just in areas where you have a combination of data, tech-savvy management, and a good starting position. If you can find those three things, this will be a broader range of winners versus, say, the cycle we had with the Mag 7 dominating market cap, the profit pool.
For the long-term investor trying to navigate this environment that we're in right now, what's one principle or piece of advice that you think is especially worth remembering right now?
Yeah, look, I was sort of thinking back to the platinum days, and my old boss, Kerr Nielsen, used to have this phrase about, beware of, growth purgatory, when you invest. And obviously it was coming, part of that was just the experience of coming out of that tech bubble and, seeing companies that like Microsoft and Cisco that actually just continue to grow relatively nicely, but their PE multiples just derated for a decade. Investors sometimes forget that, Microsoft bottomed in around 2010 on a PE of about 10, right? And it was still growing. So it's that growth purgatory, right? Growth is exciting, but you always have to pay the right price. We all want to. So now I think it's slightly different. I think that we're living through not a growth bubble, but we're living in a quality bubble. And I think my advice, to investors would be just be careful of quality purgatory. Is paying 50 times for Costco an appropriate multiple, right? Like to me, it seems like you're not pricing in the risks around the economy. You're certainly not pricing in the potential for a slower growth rate or any competitive risks. And that just seems a bit careless. And look, there's many examples of how that has unwound in the US. 5 years ago, Starbucks would have been in everyone's a core holding in a US equity core equity portfolio. Now there's a question mark. You can see Chipotle just starting to roll into that category, at 40 times. You've seen Nike, it was seen as an almost unbreakable business. Yeah, so I think it's, just be wary of the quality, the price of quality, and not overpaying for quality. It's looking for the unicorn, the cheap expression of quality. So look for it in less obvious places in the market.
As we're looking ahead over the next 3 years, should investors go out with a life jacket and weather the storm, or should they just stay in bed at home?
Look, I think you can definitely be active and be actively invested in the market. I mean, if you're certainly in that growth phase of your asset accumulation, you need to be exposed to the market. I think also valuations are not demanding outside the US. And then inside the US, I think there's a big range, so you can find cheap stocks, and that's exciting. So I think, passing peak US exceptionalism is a good thing. It's a great thing. It means the markets can broaden out, and I think it can be a much more forgiving market for stock picking. So definitely stay invested. If you're in that sort of drawdown phase, look. You've got to be mindful of some of those tail risks, and so it's really selecting a strategy that maybe has less exposure to the upside, but does have downside protection, like a variable beta long short fund. So I think you can. It is late cycle, so be mindful of tail risk, but we can also find opportunities to deploy capital with attractive returns. The other aspect of that is, Trump, the US presidential cycle, you really only get, he's a second term president. He will be facing, Congress will be facing midterms, Senate elections in about 18 months. So, you're going to have peak policy uncertainty really within that time frame. Now we don't think that doesn't mean, all of the uncertainty goes away, but, it will peak. And so, you just got to keep that in mind. And I think you've got to look through some of the tariff noise and focus. It's more about the economy, not the tariffs. It's, what happens to the economy and monitoring that pretty closely. And if the tail risks around recession really start to fatten, then you just need to be more defensive in portfolios.
Okay, great. Fascinating. Thank you, Jacob, for sitting down with Livewire today and sharing your insights, and looking forward to our next chat.
Yeah, thanks. Great to be here. Thanks, Anna.
If you enjoyed that interview, make sure to give it a like and subscribe to our YouTube channel where we release new content every week.